In mutual funds, you don't have to go outside mutual funds. You can take exposure to debt, equity, gold. What investors do, they go to one of the websites or the apps and start looking at the best performing funds.
Using past performance to select a mutual fund scheme is one of the best way to create a portfolio blunder. Most of the people look at past performance and they hope and expect the similar returns in future, which unfortunately leads to disappointment. There have been many times we have selected a portfolio with current rating of say 2-star or 3-star. We evaluated that the future performance will be good for this portfolio. Then we have often seen that 2-star, 3-star, they become 5-star after 2 years or 3 years.
There's an ongoing debate between active funds versus passive funds.
What really matters is what returns you are getting post expenses for international investments. We allocate towards theme-based ETFs.
For someone in their 40s, how would you go about structuring a mutual fund portfolio?
So let me help you understand with an example of.
Welcome to TrueMoney Talks, a brand new podcast series on personal finance presented by TrueMind Capital. I'm Shivani Chopra, your host for the day, and joining me is Sumit Duseja, co-founder and CEO of TrueMind Capital. Welcome, Sumit.
Thank you, Shivani.
So this is our episode 2 of building solid mutual fund portfolio. In our episode 1, we have covered the portfolio construction part, and in this part 2 series, we are going to discuss entirely on selection of mutual fund schemes. From a previous episode, we understood our goal is to have 10 to 12 schemes diversified across 4 to 5 AMCs, and for every mutual fund scheme, we should keep a range of 5 to 15%. Now, what investors do is usually when they know their task is to select the mutual fund schemes, they go to one of the websites or the apps and start looking at the most best performing funds. That is all based on the past historical record. Appears to be a very easy thing to do, rather the easiest thing to do, but certainly not the best on it. What are your views here?
I think using past performance to select a mutual fund scheme is one of the best way to create a portfolio blunder. Many people assume that what the returns have come in the past will also continue in the future, which never happens. I would say it's an outcome bias. It may or may not happen. The important point to understand here is that the past performance has come because of certain underlying factors. The one most important factor could be that the starting point were lower valuations or the prices were cheap. But now the past performance looks very good. That means the valuations probably have gone much higher and the prices of stocks of that portfolio has been expensive. So now when you invest at expensive valuations, then you cannot expect the similar returns going forward. So past performance could be a good metrics, but it should not be the only metrics or the whole soul metrics to determine whether you should invest in a particular scheme or not, which unfortunately most of the people look at past performance and they project the similar returns and they hope and expect the similar returns in future, which unfortunately leads to disappointment.
So apart from past performance, then what are the other critical parameters to look at before one should start selecting the mutual fund schemes?
So when we select any mutual fund scheme for our client's portfolio, the number one criteria we look at is valuation attributes of a portfolio. We'll look into the portfolio, we'll understand what is the sectoral allocation is, what are the stock selection has been done in a portfolio. Given that I come from an equity research background, preparing research reports for fund managers, so it also helps a lot in looking at a portfolio and understanding what's how the portfolio valuation looks like, what are the factors being employed to build that portfolio. Second most important factor is to understand the fund management style and investment philosophy. So when you look at the investment philosophy and fund management style, then you also select those fund managers which you think will have an upper edge or will have an edge in the current market scenario. For example, I would go with a value fund manager with a value investment philosophy when the markets are towards the end of the raging bull market, right? On the other hand, I will go with a growth-oriented fund manager when the markets have bottomed and they are starting their journey towards the bull market. So for me, it's very important to understand the investment style and investment philosophy of the fund manager, whether it aligns with what I believe should be the style going forward. Third, I look into the investment process of the fund house. So how the stock selection happens, what's the research team composition is like, how they find the ideas, and then how they evaluate and then finally decide to make part of the portfolio. How much flexibility a fund manager has to take decisions regarding the portfolio. Fourth factor, I will look at the size of the fund. So if I have two funds, one with a size of 10,000 crore, another with a size of 50,000 crore, with a similar investment objective and style, I would choose a fund with a 10,000 crore of asset under management, primarily because it's easier to manage a smaller fund than a bigger fund. Just to give you an example, if I have to take an exposure in a small cap stock with float of roughly say 1,000 crore, if I even have to take an exposure of 1% in a 50,000 crore AUM portfolio, that means I have to invest 500 crore in a 1,000 crore float of a small cap company. Now, taking exposure of 500 crore will take the prices significantly high. Correct. On the other hand, if you have to exit from that stock, the prices will crash like anything. So it limits the flexibility for a fund manager to invest in small cap or a mid cap stock, and that's why they stick to large cap stocks in that scenario and cannot take advantage of opportunities in small and mid cap space. A smaller fund size of say 10,000 crore would still be able to exploit the opportunities in small and mid cap.
But any exception to this wherein you think that the mutual fund schemes where there's a higher corpus, because they have built that corpus over a number of years, they have become popular perhaps, which is why more and more investors have invested in this particular mutual fund scheme. Would you give the benefit of doubt because they've been doing a great job, which is why their corpus has grown? So any exception to this rule?
Only when the investments are being done focused on large cap market capitalization. Because in large cap, we have so many companies with trillions of market capitalization. The volumes are easily available. You can take exposure easily. So I would not have the sizing factor into account for a large cap portfolio.
Large cap oriented mutual fund portfolio schemes.
Lastly, it comes the performance. Of course, I need to look at the performance as well. But what I look into performance is to understand how a fund manager has performed during different market cycles, at different stages of market cycles.
Okay. So you look at on a long-term basis. There's also a concept of rolling returns. So for the benefit of our viewers, if you can help them understand.
Rolling returns simply means that you are evaluating the returns for a particular time period in a time frame of say 20 years. For example, you are trying to evaluate returns of 3 years performance in a time frame of 20 years. So what returns you have generated starting the portfolio say 20 years ago, then after 1 month another 3 years, then after 1 month another 3 years. That help us understand how the portfolio performance has been during different stages of market cycle. That is one of the good metrics to understand how the portfolio has performed. But as I said, portfolio performance, how a fund manager has been able to navigate during different market cycle, it's very important. When the markets have corrected, how much the portfolio has corrected. When the market has gone up, how much the portfolio has gone up. Whether the performance is delivered on a consistent basis or not. That is very important for me to understand.
And this data, it is completely missing for the new fund offers.
That's why we never recommend a new fund offer to our clients. I think unless there is a track record, unless we have something to understand and evaluate about the portfolio and the fund manager, we have never recommended any NFO to any of our clients' portfolio.
So Sumit, you just talked about the other critical parameters, which are the valuation attributes, the AMC's reputation of the fund manager, their whole investment process, and a couple of other important things. Where can investors go and check all this?
A lot of literature is available either on the mutual fund website or in the media. One just needs to look into it and dig and also try to see how a fund manager performed in the past, which data is very much easily available on so many websites. You have to also be mindful of the change in the fund manager in a particular scheme. So when a fund manager changes, whether it aligns with my understanding of how a style should work going forward. Another very important aspect I want to add is most of the star rating that happens on various websites, that accounts significantly for the past performance. So if you look at star rating of say 5 star of a particular scheme and you invest accordingly, there are high chances you will be disappointed. There have been many times we have selected a portfolio with current rating of say 2 star or 3 star because past performance has not been that great, but because we evaluated that the future performance will be good for this portfolio and probably there is a change in the fund manager, then we have often seen that 2 star 3 star they become 5 star after 2 years or 3 years, right? So that's where one needs to really look at the portfolio valuation attributes and other factors before putting performance into the overall criteria to select a scheme.
So since we are discussing about the selection of mutual fund schemes in this particular episode, there's an ongoing debate between active funds versus passive funds. What is your take on it?
Yes, there is a raging debate between active and passive funds, primarily because of expense ratio. Usually passive funds have low expense ratio, active funds have slightly higher expense ratio. But what really matters is what returns you are getting post expenses. That should be the criteria to determine whether you should be investing in an active fund or a passive fund.
There's also a perception that it is easier, much easier to understand a passive product as compared to an active product. And also people are then drawn towards passive investing.
Because there has been a lot of articles, media articles, a lot of perception that has been created that passive funds have been doing phenomenally well compared to active funds, which is true in a large cap portfolio space, wherein over a 10-year period, 60% large caps underperformed and 40% active large cap portfolios overperformed compared to the index, which can be a passive fund, which could be an index. Now, what we have seen is that this underperformance has been observed over a period of 10 or 15 years in a raging bull market. We have not gone through a strong bear market which lasts for about a year, 2 year, 3 year. COVID correction was not a bear market because the markets went down and they came up also very fast. So nobody has seen what exactly bear market is like. So when the portfolio goes through a bear market also, in that scenario, we have yet to see whether active portfolios are doing better or passive portfolios are doing better. So jury is still out. So unless we go through this cycle of bull market and bear market, we would never know exactly that how active funds are performing vis-a-vis passive fund. Another very important aspect is that we have been able to identify good large cap portfolios, active portfolios, which have done much better than the index. So if I'm able to identify these portfolios, I do not have to select passive funds for large cap allocation. But given that we are agnostic towards any product, we can have passive fund if we believe that they are doing better than active funds even in a bear market.
So you think that in India, there are ample of opportunities to pick mutual fund schemes, which will be generating alpha for our clients. Picking active schemes is better than the passive schemes. So that's about the India story. But what about the more developed economies and markets such as US?
Certainly, I mean, there has been clear-cut understanding of active funds underperforming passive funds in international markets. In US and other developed economies, active funds have underperformed many passive funds. That's why for our international exposure, for the portfolios we manage for our clients for international investments, we allocate towards theme-based ETFs, which has low cost, and we have been able to get better outcome compared to an active fund outside India. So internationally, it makes a lot of sense to allocate in ETFs.
Okay. again, we are on the topic of mutual fund selection. There's also a category which is hybrid fund. And a hybrid fund offers a mix of debt and equity. And then there are several subcategories under the hybrid fund. According to you, where does hybrid fund fit in?
Hybrid fund is essentially for passive management.
What do you mean by passive management here?
If someone is not looking at the portfolio actively, and changing the allocation between equity, debt, and gold.
So someone who's not doing asset allocation actively.
Certainly.
Okay.
My problem with the hybrid fund is that the expense ratio that is applicable on equity is also applicable to debt and gold in a hybrid structure. Whereas if you invest separately in equity, separately in debt, and separately in gold, your overall expense ratio of the portfolio goes down. Second, I get a clear-cut understanding of how much equity I have in the portfolio, how much debt I have in the portfolio, how much gold I have in the portfolio.
So it offers a more customized approach?
Certainly. So hybrid funds are essentially for someone who doesn't want to review and monitor the portfolio on a regular basis and do not much inclined for a customized portfolio. So it's like a standard product. You can have few hybrid funds in the portfolio, but that also requires a clear-cut understanding of how much risk is there in the hybrid fund. And then accordingly, what matches your risk profile, you need to select those kind of hybrid funds in the portfolio.
So I think it's right time for us to go through a working example of everything that we have been speaking in our episode 1 and episode 2 together. My question for you, Sumit, will be, for someone in their 40s, how would you go about structuring a mutual fund portfolio?
So let me help you understand with an example of one of our clients. 2 years ago, a client came to us. He's a professional, age 42 years, with monthly expenses of 3 lakhs, annual savings of 70 lakhs, and current portfolio size of 4 CR. He has goals for his daughter's education, as well as her marriage, and certainly for his own retirement. He wants to retire after 13 years at the age of 55. We understood his risk profile as aggressive. We did a cash flow projection to understand how well he will be able to achieve his goals. And at the age of 55, when he desires to retire, he needs a corpus of roughly 25 CR, including the marriage goal as well. But given the current portfolio size and the savings he was able to do, he could only reach 21 CR. That means there is a shortfall of 4 CR. Now, how to meet that shortfall? So we advised our client that either he should delay his retirement or he increases his savings. Client understood this and he decided to increase his savings and add to the portfolio. Once that understanding was developed, now next step was to create a portfolio. We designed his portfolio across equity, debt and gold, given his risk profile as aggressive and given the market levels were higher when we designed his portfolio. His equity allocation in the portfolio was only 45%. Debt allocation of roughly around 40% and remaining was into gold. Within equity also we selected large value portfolios. We stayed completely away from mid and small cap. In the debt side, we allocated to arbitrage fund because he falls in a higher tax slab. So it makes a lot of sense to allocate in arbitrage fund to get tax efficiency. Then again, gold, as I said earlier also, is a very important part of all our clients' portfolio to help protect against any negative aspect in the economy and impact on the equity markets. As of today, his portfolio allocation to equity is around 55%. We increased allocation because markets corrected and we reached to a level which are more reasonable to allocate higher to equity. His gold allocation also delivered higher returns. Debt allocation provided provision to invest in equity. We still have big amount in debt because there is a provision that we have to make for different market cycles and stages of the market cycle. That's how the portfolio has been designed, and so far it has done very well on the risk adjusted basis. That's how the portfolio management is done, and that is essential to regularly review, monitor and do the rebalancing as and when needed.
And exposure to gold, that is also done by mutual funds?
Yes, that is also done by through mutual funds, and that is something we believe should be a very important part of the portfolio.
So in mutual funds, you don't have to go outside mutual funds. You can take exposure to debt, equity, gold. A lot of investors are not aware that there are gold mutual funds schemes which are available to invest, again in a very, very simple and tax efficient manner. Probably one of the last questions I would have is, what about flexi-cap funds? Because we have discussed about active funds, passive funds. We also discussed about the hybrid funds. We also discussed about large cap value oriented funds. What about flexi-cap funds? And I'm thinking on behalf of people who probably do not know what is the right mix of having exposure to large cap, mid cap, and small cap schemes. Will it be beneficial for them to opt for flexi cap funds?
So flexi-cap fund by its name says that there is a flexibility to a fund manager to allocate either to large cap, mid cap and small cap. And it's one of the best way to invest in a mutual fund, because a fund manager would be able to take a better call that when the valuations are attractive in the large cap, mid cap and small cap. For example, we also have some flexi-cap funds in our portfolios, wherein we saw that most of the flexi-caps are allocated to large cap. 80% portfolio allocation would be, say, to the large cap and remaining 20% to mid and small cap. So that kind of flexibility a fund manager enjoys in a flexi-cap fund.
So in flexi-cap funds, the other advantage is that the fund managers also take sectoral calls. So there's no additional necessity of choosing sectoral mutual funds.
Certainly, and another advantage which I've seen in some of the fund is that a fund manager is able to take calls outside India as well. Stocks in US or stocks in China or other emerging markets. So that flexibility also has been used by many fund managers in their portfolios. For us, it's important to understand how a fund is constructed, where all the opportunities are available, and how well a fund manager is able to take advantage of these opportunities.
Thank you so much, Sumit. It was wonderful to hear all your thoughts on the selection of mutual fund schemes. And curtains down for our second episode as well. We will be meeting you in episode 3, in which we will be talking about how to manage uncertainty in the stock market world. Thank you so much, and we will see you soon.